Hello everyone, welcome to the part 3 of our introduction to Forex. In our last lesson we talked about buying and selling, talked about when to buy and when to sell, we talked about going long and going short, we talked about when the currency value is expected to rise, we buy, when the currency value is expected to fall, we sell. So those are the basic things that you must know. And now on the charts, from the picture you see here, this is the live chart of the market, the movement of the price, and you can see from the box here, you see the price going down. So from the top here we sell, from the bottom here we buy. See the chart going down, see the chart going down. So when price is going down, we are expected to sell. When price is going up, we are expected to buy. So this is what a typical chart looks like in the Forex market. Okay, so we'll dive right into this in more details in our subsequent videos. So for today, we're looking at what is a pip, because pip is the SI unit of measurement of price action. Okay, the movement of price is what is called a pip. All right, because price has a particular value. There's a particular number that the price of a commodity or an asset or a currency should have. For example, when we talk about quotes, when we're understanding Forex quotes, we said we sell the base currency. Okay, we buy the base and we sell the quotes. Okay, now you see the particular number here. This number is the price number of this currency. That's the rate of this currency. And this number here you see is the rate of this currency. So every currency has a rate, and it is the rate you use to buy it or sell it. So on this note, we talk about the pip. So the unit of measurement to express the change in value in the market. The pip is nothing more than the 4th decimal number after the comma. So once you have a 4-digit number representing the value of a currency, the last digit is known as the pip. And how do you calculate the pip? For example, you are trading a currency NZD USD at 4.56567 and you exit at 4.56772. How many pips? So you have to minus, you remove the entry point from the exit point. Okay, that is how the pip is gotten. So you remove the entry point from the exit point, then you now take the 4th decimal place. You take 4 decimal places to get the number of pips that the price has moved, just like this example here. So in a market that has the entry point and the exit point, you now minus it, then you move your decimal places 4 places, and then you can have the number of pips that the market has moved. So for example, this is a typical Forex chart. You have the entry point, you have the entry here, you have the exit point, and this is the price rates. Okay, so for a currency like the NZD USD, now this is the chart of the NZD USD, the price chart. Now you see the entry point here at 1.09207. We enter the market here and we exit the market here at 1.08962. So how do you know how many pips the market has moved, which is the SI unit of the price action, the SI unit of price, the extent to which price has moved, because that's how you're going to calculate how much you make and how much you lose. So to calculate this, you remove the entry point from the exit point, and then you slide 4 decimal places to get the exact number of pips that the price has moved. Okay, so that is how we get it. But for this rule is exception to yen pairs and to gold pairs. Remember we talked about 8 major currency pairs. Is that not right? We talked about 8 major currency pairs. Then we talked about the Great Britain pounds. We talked about the euro. We talked about the USD. We talked about the Australian dollar. We talked about the New Zealand dollar. We talked about the Canadian dollar. We talked about the Japanese yens. All right. So the Japanese yens, their price rate is in 2 decimal places. It's not unlike the other prices. So a typical chart of the Japanese yens, for example, the USD JPY, would be like this. They were going to be decimal places. There has 3 decimal places price action. So when we're evaluating to get the number of pip movement, we use 2 decimal places to the right. Is that all right? So when the chart is like this, you look at the entry point, you look at the exit point, you minus it, and then you move your decimal places 2 places. That is where you get to have your pip movement. That is the SI unit of price, how price has moved so far. Okay, all right. So that is pip for you. You need to learn this thing and you need to know it very well, so that you can be able to actually, know the extent to which your trade has moved. Is very, very important. So another thing I want to talk about is leverage and lot sizes, because you need to know what lot size you're going to take in buying a particular currency. Lot sizes are different, and it depends on the account you are trading. It depends on your account. Okay, that's how you have to know the lot size that is appropriate for your account. Why the leverage has to do with the broker. The broker gives you a leverage to enter the market. It is the broker that determines the leverage you use in trading. All right. So when we talk about lot size, we talk about refer to contract being made of certain prices, of certain sizes. For example, if you purchase a whole pack of canned water and you buy one, it's not the same. The amount of money you used to buy the pack and the amount of money you used to buy one is not the same. So you need to know how much money you are willing to put into the forex market, and that will determine how much money you'll be able to get and how much money you can lose also. So the lot sizes are different. We have the standard lot, we have the mini lot, we have the micro lot, and the nano lot. All of them have their units of measurement of price. Okay, so for example, for a standard lot, the units that you are able to purchase in the forex market of a currency, the units of currency you can purchase is 100,000, and the volume that can be given to you is 1.00, which of course, if price moves in your favor, for 1 pip, you are going to get $10. Okay, for 1 pip. So for a $100,000 account, you can use a volume lot of 1.0. You can use a lot size of 1.0, and for 1 pip movement you get $10. Now for a $10,000 account, you can use a volume of 0.10 cents, okay, which of course will give you $1 per pip movement. So imagine the price move 25 pips in your favor, you have gotten $25. So you see how you use the pip to correlate with the lot size and the volume, which is of course the lot size. Is that okay? So it is the amount of money that you have. This is the amount of money that you have that you can use to now purchase a currency in the market. So if you have $1,000 account, you can buy a lot size of 0.01 cents, and of course of the lot size 0.01 of lot, then you make 0.10 cents per pip movement. So every movement of the price in your favor in pips will give you 0.10 cents. Okay, so nano lot for a account of $100, you are expected to use or buy a volume of 0.001, which of course will give you 0.01 cents per pip. Remember, price can be measured in any currency you want to use, depending on the broker, but some brokers only offer price movements or price measurements in dollars, okay, because it's the highest traded currency in the world. So most of the time, once you become a Forex trader, know that you're going to be counting and calculating in dollars. All right. So this is an information you must understand, that for an account, for an account of $10,000, this is how many volume you are expected to use per trade when taking a trade. That is the highest you are expected to use, so that you don't blow up your account. Is very, very important. So on our MT4 platform, which of course I'll be introducing us to, I will be learning how to actually take a trade, how to enter the volume, and how to take a trade, and how to understand other things. So but for now, let's go to the leverage. Now the leverage is given to you by the broker. It is the broker that assigned the leverage to you. The leverage is, the broker is like a middleman. He charges you for spread. So he divides every amount you put in your trading account. The broker divides it and then adds to it, so that you can have enough money to trade. So you need to know how to use the leverage accurately. You need to know how to use it accurately, so you don't take a leverage that is more than your account size. Okay, so for a beginner account, you're expected to take a leverage of 1 to 100 or 1 to 200, maximally 1 to 500. So for every $1 you have in your account, the broker will give you $100 opportunity to trade in the Forex market. So the broker gives you leverage to help you trade better, while they also charge you for their spread, because that is how they make their money. Okay, so that is that. Now we want to look at orders in the market, how to take orders in the market. What are orders? We talk about limit and stop orders. Very, very important. Now, to enter the market, there are things you must know. You can use limit orders, you can use stop orders, you can use instant execution. You can enter the market with an instant execution. When price is already moving, you can use a limit order, you can use a stop order. Let's look at the stop order of entering the market. Stop orders are threshold, has to be crossed only once before you can enter into the market. Stop orders are like a race. Once you cross a threshold, you are entered into the market. So this is it. When price, for example, when price is moving in an upward direction and the price decides to come down, a stop order will help you to enter the market at a particular limit. Okay, we help you to enter the market at a particular limit. For example, when you're expecting price to drop, then when you put in a line like a threshold, when price crosses it, you enter into the market. So in an example of a live chart, this is an example of a live chart. All right, so once the market crosses this line, a sell stop, you are entered into the trade and the market begins to move. So that is when your money starts counting. So that is for a stop or a sell stop. A buy stop is the same thing. When the price is moving up, a particular line you should cross before you are entered into the trade. So that is for that. Then we have limit orders. You can use sell limits, and also you can use buy limits. A limit order helps you to take an order in the opposite direction. So a simple understanding to market executions, or how to enter the market to buy or to sell, is either to use a buy stop. The price crosses the line, you are entered into the market. You can use a sell stop when price is going down. You can use a buy limit. Okay, then you can use a sell limit. All of this will be explained more in depth in our subsequent classes, but for now these are just introduction to taking orders in the market. So right now I want to look at some of the things you need to know. We want to talk about a stop loss. So what is a stop loss? Okay, a stop loss helps you to take a loss in the market. Well, for example, it's a level you can set in the market that when price gets to that place, it should take you out of the market. Okay, so it determines your exit point on the market. For example, you bought at a particular rate, at a particular price, then the market moves against you. So it's a particular place you want to take partial profit, or you want to leave the market, you put in a stop loss there. So a stop loss helps you to leave the market when the price goes against you. That is that. A stop loss makes you helps you to leave the market when the price. So if a trade goes the wrong direction, your stop loss will stop the order after a certain price limit has been reached. So you set the limit that the price will get to, and then you can leave the market. So it's very important in aspect of risk management. You need to always employ risk management while trading. It is very, very important. You need to set a stop loss. So for example, look at this chart here. You see this is an entry point. Look at the stop loss above the structure here. For example, if price goes up back here to get to this point, you will be exited from the market. Okay, so but from here, if price goes in your favor, you have entered into a position already. So all of these things are very important. You need to know them perfectly. Now, some other thing we want to look at is technical analysis. This is one of the backbones of forex trading. I will do more in-depth analysis on this, and after that we will look at how to start trading, open an account and start trading. So technical analysis, this is the type of analysis used by traders to study the price movement. Trader studies the closed price movement in order to determine where price could go. So you need to study it, you need to know how price is moving using a principle called technical analysis. It helps you to study the price movement, and then you can make a decision on what to trade. There are different ways you can do technical analysis. You can use charts, you can use indicators, you can use price patterns. Charts are the normal price movement, the candlesticks that are moving. Then you can use indicators like your moving averages just to measure the price. Then you can use price patterns, then price charts. You can use different price action templates to measure your technical analysis. Then also after technical analysis, we have what we call the fundamental analysis. This type of analysis that includes political, social, and economical news to gauge how the market will do with a country's potential economical outlook. If a certain country does well, then their currency should do well. So fundamentals has to do with the country's economy, the news release. That these are things that move the market. When news is released in a particular country, it moves the market. Then the last one we'll talk about is sentimental analysis. This is the overall feeling of the market. It is not as important to understand every detail of news, but more important to get how people are responding to the news and how that shows up in the market. You need to know what people are saying about the economy. You need to know how people are reacting to the economy, because at some point, if the buyers of a currency are more than the sellers of a currency, then definitely the economy is going to buy. The currency is going to buy. So you need to know what people, other traders are saying, are doing, or the positions the banks are taking. What position the bank are taking in a particular currency. Are they going to buy or are they for sales? You need to know all of this. So after knowing all of this, the next thing you must do is create a trading plan. This is very, very important, and it is the gateway to being proficient in trading. You need to have a trading plan. As a trader, you need to know when to trade, how to trade, and what to do and what not to do. You need to be specific with your trades. You need to enter your trades with precision. You need to be sure of what you're doing. You need to calculate your pips in profit and your pips in loss, how much you are going to lose and how much you are willing to gain. So all of these are very, very important as a trader to developing a trading plan. So now, first of all, you need to ask yourself, why are you trading? Okay, why are you trading? You need to know why you are trading. Then after you've known why you are trading, you need to know what type of trader are you. There are different types of trading. For example, you can be a position trader. You can just take a position in the market for maybe months, for weeks, for days. Or are you a swing trader? Take a position for weeks. Or are you a day or intraday trader? You trade within the day. And also, are you a scalper? You want to be scalping, just taking maybe 5 minutes trades, 15 minutes trades. So you have to define yourself. You have to define the kind of trader you are. Are you going to be trading for long term, or are you going to be trading for short term? Do you have all the time to trade? Do you have all the resources to trade? Okay, you need to know all of this. Then you need to know, do you prefer fundamental trading to technical trading, or you prefer both? Because some people prefer to trade only the news, and some people prefer to trade technical analysis, just looking at price movement, and then they place their orders on how they feel the market is going to go. Or are you waiting to just take the news? Maybe there's a news that the currency is rising, and you just take your buy position. That in this news the currency is going to sell, you just take your sell position just to trade the news. So you need to know all of this. Then also you need to know what sessions are you trading. Remember, we talked about sessions. We said there are 4 major market sessions. We need to know which session you're trading. Is it the Sydney session? Is it the Tokyo session? Is it the New York session? Is it the London session? Sorry, is it the New York session, which is the last session of the day? So, and each of these sessions, you are told that there are currencies that move in these sessions. So you need to know the currencies that are moving in that session, the ones you want to trade, the specific time to trade. So you need to know the specific time to trade. When do you want to trade, or when do you like to trade? Because you need to answer these questions in order to develop a good, clear trading plan. So before you enter the trade, what is your criteria for getting in? You need to know how to enter the trade, and you need to know the reasons you are entering the trade, the criteria that must be met before you enter the trade. So you need to know also, how many pips do you want minimum out of each trade? What is the how much you want to make per trade? How much do you want to make per the movement of price? Are you going to be targeting 15 pips, 20 pips, 100 pips? You need to know all of this together. So in our next class, we'll be walking you through how to open an account with a broker, and how to open your MT4 platform, and how to begin to take trades. Okay, all right, thank you very much.